2005, Cupertino, California. A doctor sits alone in his office at 3 a.m. He has no MBA, no Wall Street experience. He runs his hedge fund from a small office above a strip mall. But he has just calculated something that nobody else has calculated. The entire American mortgage system is built on a mathematical impossibility. Within 3 years, it will collapse and take the global economy with it. His name is Michael Burry. He will bet his investors' money against the system. Goldman Sachs will laugh. His investors will sue him. The world will call him insane, and then in 2007, he will be proven right. He will make $750 million. His investors will make billions. This is the story of the man who saw the greatest financial crisis in history mathematically and almost destroyed himself trying to convince a blind world. Michael Burry was born on June 19, 1971, in San Jose, California. His childhood was marked by a single defining event. At age 2, he lost his left eye to a rare cancer called retinoblastoma. He would wear a glass eye for the rest of his life. This single fact would shape everything about how he interacted with the world. He felt that other people could never look at him without seeing the glass eye first. Eye contact became impossible for him. He learned to communicate by avoiding faces and focusing on objects, numbers, and patterns instead. He would not be diagnosed with Asperger's syndrome until decades later, but the patterns were clear from childhood. Intense focus on specific topics, difficulty with social interactions, an extraordinary ability to see numerical and logical patterns that others missed. He was a brilliant student. He attended UCLA for his undergraduate degree, where he developed an early fascination with the stock market. While other students focused on social life, Burry spent his time reading investment letters and studying companies obsessively. He went to medical school at Vanderbilt University, intending to become a neurologist. But during his medical training, he discovered that what he truly loved was investing. He began keeping a public investment blog under his real name, posting his analysis of specific stocks late at night between hospital shifts. His blog became unexpectedly famous within the investing community. Hedge fund managers and Wall Street professionals began reading his posts. They were stunned by the depth of his analysis. They could not believe a medical resident was producing some of the best investment writing on the internet. In 2000, professional investors approached him with a proposal. They wanted to fund his transition from medicine to investing. They offered him capital to start his own hedge fund. Burry was 30 years old and had no formal finance background. He accepted. He left medicine. He named his hedge fund Scion Capital, after a fantasy novel he had loved as a child. The name itself reflected his outsider status. Wall Street firms had names like Goldman Sachs, Morgan Stanley, Lehman Brothers. Burry chose a name from fiction. Scion Capital began with approximately $1 million in initial capital, much of it from his own savings. He set up his office in Cupertino, California, far from Wall Street. He worked alone for the first years. He had no team. He had no Bloomberg terminal initially. He had himself, his computer, and his obsessive ability to read financial documents. His early investment results were extraordinary. In his first year, he beat the market by significant margins. Investors began noticing. By 2003, Scion Capital was managing over $250 million in assets. By 2005, it would manage over $600 million. His investment style was distinctive. He focused on what he called ick investments, companies and securities that other investors found unpleasant or unfashionable. He read documents that nobody else read. He calculated risks that nobody else calculated. In late 2003, something began to bother him. He had been reading prospectuses for residential mortgage-backed securities, financial instruments built on bundles of American home mortgages. The mathematical assumptions underlying these securities troubled him deeply. Specifically, the assumption was that home prices in different American cities would never decline simultaneously. The entire valuation of these instruments depended on the idea that if Miami home prices fell, San Francisco home prices would compensate. The data did not support this assumption. He began reading more deeply. He requested and read documentation that almost no professional investor had bothered to examine in detail. The 1,500-page prospectus for a typical mortgage-backed security. The underlying loan documents, the borrower qualifications. What he found was extraordinary. Many of the loans being packaged into these securities had been issued to borrowers who could not possibly repay them. Variable rate mortgages to people without income verification. Loans to borrowers with terrible credit. The whole system was built on the assumption that home prices would only rise. By the end of 2004, Burry had reached a mathematical conclusion that almost nobody else had reached. The American residential mortgage market was a structural impossibility. It would collapse. The only question was when. The securities were rated AAA by the major credit rating agencies, but the underlying loans were of catastrophic quality. Many were variable rate mortgages issued to borrowers who could not document their income. Loans approved with no down payments. Loans to people with terrible credit histories. Burry began constructing a mathematical model. He calculated what would happen if home prices stopped rising. The results were catastrophic. The entire mortgage-backed securities market would collapse. Trillions of dollars in supposedly safe investments would become worthless. But there was a problem. There was no obvious way to bet against this system. Mortgage-backed securities were not like stocks. You could not simply sell them short. The financial instruments for betting against them did not exist in tradable form. Burry began researching credit default swaps. These were insurance contracts on debt. If you bought a credit default swap on a bond, you received payment when that bond failed. But credit default swaps had not been widely used for mortgage-backed securities. Burry would essentially need to create the market himself. In early 2005, Burry contacted Goldman Sachs and several other major investment banks. He explained what he wanted to do. He wanted to buy credit default swaps on specific mortgage-backed securities he had analyzed. He wanted to bet that they would fail. The investment bankers were confused. They could not understand why anyone would bet against AAA-rated securities. The bankers thought Burry was making an obvious mistake. They were happy to take his money. They created the credit default swaps and sold them to him. By the end of 2005, Burry had invested over $1 billion of Scion Capital's capital in credit default swaps on mortgage-backed securities. This represented the majority of the fund's assets. He had bet the company on his mathematical analysis. There was one immediate problem. Credit default swaps required ongoing premium payments. Burry was paying millions of dollars monthly to maintain his position. If home prices kept rising, he would slowly bleed money. The position required patience. His investors began to notice. Scion Capital was reporting losses while the broader market was up. Burry was investing in something they did not understand. They began asking questions. They became increasingly aggressive in their questioning. Burry tried to explain his analysis. He sent detailed letters describing his calculations. He showed the mathematical impossibility of the mortgage market. His investors did not want to hear it. They wanted to know why their returns were negative when everyone else's were positive. Other investors began making similar bets, though most started later than Burry. Steve Eisman at Front Point Partners reached the same conclusion through his own research. He had grown up in finance. He had seen Wall Street fraud before. He recognized the pattern. John Paulson, a less prominent hedge fund manager, also became convinced. He made an even larger bet than Burry. He raised dedicated funds specifically to bet against the mortgage market. His position would eventually exceed $15 billion. Charlie Ledley and Jamie Mai ran Cornwall Capital from a garage in Berkeley, California. They were even smaller outsiders than Burry. They saw the same pattern in the data and made similar bets with their tiny capital base. Greg Lipman worked at Deutsche Bank. He was on the inside of the system, but the math was unavoidable. He began aggressively selling credit default swaps to clients, while also positioning his own employer to benefit from the inevitable collapse. He had a conflict of interest that he made no effort to hide. All of these investors were making the same fundamental bet. The American mortgage market would collapse. They were a tiny minority. Most of Wall Street was on the opposite side of their bet. The major banks held the very mortgage-backed securities these outsiders were betting against. Throughout 2006 and into 2007, the pressure on Burry intensified. His investors were furious. The mortgage market was not collapsing. Home prices were still rising. He was losing money in premium payments while everyone else was making money. His investors began threatening legal action. They demanded the ability to withdraw their money. They argued Burry had misrepresented his investment strategy when they had committed funds. Some filed actual lawsuits. Burry took the extraordinary step of suspending withdrawals from Scion Capital. He invoked a clause that allowed him to do this temporarily. His investors were enraged. Trust in him collapsed entirely. He was alone. He had bet his fund, his career, and his reputation on a mathematical analysis that the entire financial world rejected, and the system was not yet showing any signs of breaking. By early 2007, Michael Burry's position had grown to extraordinary scale. He held credit default swaps with face value exceeding $1.9 billion. His monthly premium payments had reached millions of dollars. Scion Capital's reported performance was devastating compared to the booming broader market. Most of his investors had reached the conclusion that he was either incompetent or insane. Some believed he was committing a form of fraud by refusing to allow withdrawals. Hate mail arrived regularly at his Cupertino office. Lawsuits multiplied, but the data was beginning to shift. In late 2006 and early 2007, subtle indicators began appearing in the mortgage market. Delinquency rates on subprime mortgages were rising slightly. Some smaller mortgage lenders began experiencing problems. The first cracks in the system became visible to those who knew where to look. Wall Street remained essentially unconcerned. The major investment banks held trillions of dollars in mortgage-backed securities. The credit rating agencies maintained their AAA ratings. The Federal Reserve under Alan Greenspan continued to declare the system fundamentally sound. The strangest aspect of Burry's situation was that even as the system began to crack, the value of his credit default swaps was not rising. The investment banks that had sold him these instruments were marking them at low values because nobody else wanted to buy them. The market had not yet recognized the danger. This created a perverse situation. Burry was mathematically correct. The system was beginning to break exactly as he had predicted, but his investors were seeing his positions valued at devastating losses on their monthly statements. The market disagreed with reality. In April 2007, New Century Financial filed for bankruptcy. It was one of the largest subprime mortgage lenders in the country. Its collapse should have been a wake-up call for the entire system. Instead, Wall Street treated it as an isolated incident. In June 2007, two Bear Stearns hedge funds that had invested heavily in mortgage-backed securities collapsed. Bear Stearns initially tried to rescue them with $3.2 billion in capital. The funds failed anyway. This should have been the moment when the broader system understood what was coming. But again, Wall Street and the financial regulators treated these as isolated problems. The credit rating agencies maintained their AAA ratings on the broader mortgage-backed securities market. The investment banks continued to hold massive positions in these securities. The systemic certainty remained intact. For Burry, this period was psychologically devastating. He was watching his analysis prove correct in real time, but the financial system was institutionally incapable of acknowledging it. His investors continued to demand explanations and threaten legal action. He had been right too early, and being right too early was indistinguishable from being wrong. In July 2007, the major credit rating agencies finally downgraded substantial portions of the mortgage-backed securities market. This was the moment when the system could no longer maintain its collective fiction. The reality that Burry had calculated 3 years earlier finally became institutionally acknowledged. The July 2007 rating downgrades marked the beginning of the visible collapse. Within weeks, the value of mortgage-backed securities began declining dramatically across the market. Credit default swaps that had been priced at minimal values suddenly became valuable. The reality Burry had calculated was finally being recognized. But for Michael Burry, personally, this was not a moment of triumph. His relationship with his investors was already destroyed. Many had filed lawsuits. Some had successfully forced partial withdrawals. The legal infrastructure of Scion Capital was under siege. By late summer 2007, Burry's credit default swap positions had become enormously valuable on paper. His mathematical bet was being vindicated. But monetizing this position was extraordinarily complex. The investment banks that had sold him these instruments were now on the wrong side of the trade themselves. Some investment banks attempted to delay payment on the credit default swaps. They argued about technical contract terms. They claimed the documentation was ambiguous. They tried to renegotiate the contracts. The same banks that had eagerly sold these instruments to Burry now did not want to pay what they owed. Burry was forced into prolonged legal and financial battles to receive what his contracts entitled him to. He spent months pursuing payments from the banks. Each transaction required individual negotiation and verification. The system was making it as difficult as possible for him to collect. Throughout this period, the broader financial crisis intensified. In March 2008, Bear Stearns collapsed entirely and was acquired by J.P. Morgan Chase in a forced sale. In September 2008, Lehman Brothers filed for bankruptcy. The financial system that Burry had predicted would fail was failing exactly as predicted. But Burry himself was psychologically broken by the experience. The years of legal threats from his investors, the social isolation of being right against the consensus, the systematic delays from the investment banks. He had been correct, but the cost had been immense. In late 2008, Burry began the process of returning capital to his investors and closing Scion Capital. The fund had produced extraordinary returns. From its inception in 2000 to its closing, Scion Capital generated approximately 489% in returns. The investors who had threatened to sue Burry made massive profits. But Burry himself was done with the investment industry. He felt fundamentally betrayed by his own investors. The people who had committed capital to him, who should have trusted his analysis, had spent the most critical period of his career attempting to destroy him through lawsuits and pressure. The final amount Burry personally earned from the trade was approximately $100 million in fees and personal investment returns. His investors collectively earned approximately $750 million from his bet. By any reasonable measure, it was one of the most successful individual investment bets in financial history. Yet Burry's relationship with his investors had not been repaired. Many continued to question his judgment and methods even after being proven right. The collective inability to acknowledge his correctness extended even past his vindication. Steve Eisman at Front Point Partners earned similar massive returns from his parallel bet. John Paulson made over $4 billion personally from his even larger position. Charlie Ledley and Jamie Mai of Cornwall Capital turned their tiny capital into over $80 million. Greg Lippmann's positioning at Deutsche Bank generated billions for the bank itself. All of these outsiders had been correct. All had profited massively. But the institutional financial system was largely unchanged. The same banks that had created the crisis continued to operate. Many of the same executives remained in their positions. The same credit rating agencies continued to issue ratings on similar instruments. By the time the broader financial crisis ended in 2009, the structural problems Burry had identified remained essentially unchanged. The institutional infrastructure that had enabled the crisis was preserved, repaired with government bailouts, and allowed to continue operating. Burry returned to managing his own personal money after closing Scion Capital. He largely withdrew from public investment management. He gave occasional interviews about specific topics that interested him, but generally maintained a private existence. The fundamental lesson of his experience was something that most people in the financial industry did not want to acknowledge. The crisis had been mathematically obvious to anyone willing to do the analysis. The reason it had nonetheless happened was not a failure of information, but a failure of collective will to confront uncomfortable truths. This is the lesson that history continues to refuse to accept. Burry himself has continued to point this out, often through cryptic public statements that the financial press treats as eccentric rather than instructive. In the years following the 2008 financial crisis, Michael Burry largely disappeared from public investment commentary. He gave occasional interviews. He invested his personal money in various unconventional positions. He developed an interest in water as a long-term scarce resource. He explored other contrarian positions that the broader market dismissed. In 2010, Michael Lewis published The Big Short, a book that documented the story of the outsiders who had predicted the crisis. Burry was a central figure in the book. The book became a bestseller. In 2015, it was adapted into an Academy Award-winning film. Christian Bale played Michael Burry. The film won critical acclaim. For Burry personally, this cultural recognition was strange. The financial industry that had rejected his analysis when it mattered now celebrated his foresight as historical curiosity. He was invited to speak at conferences. He was treated as a kind of folk hero of the financial crisis. But Burry was acutely aware that the cultural celebration was disconnected from genuine institutional learning. The same banks that had created the 2008 crisis continued to operate with similar practices. The credit rating agencies continued to issue questionable ratings. The regulatory framework had been modified at the margins, but remained fundamentally similar. Burry began making periodic public predictions about new structural problems he saw in financial markets. He warned about index funds creating systemic risk. He warned about asset bubbles forming in various markets. Most of these predictions were treated by the financial press as eccentric pronouncements from a famous contrarian. The Burry story leaves history three concentrated lessons that connect with the central thesis of this channel. The first lesson is about collective certainty as the most dangerous form of certainty. When an entire system shares a belief, that belief becomes invisible even to its participants. The dissidents are not deliberately ignored. They are literally incapable of being heard because their message does not fit within the consensual reality. This is the lesson that Burry's experience embodies most fully. The second lesson is about institutional structures reinforcing blindness. Burry could see what the insiders could not because he had no career to protect, no boss to please, no reputation tied to consensus. The structure of Wall Street itself was designed to produce conformity, not lucidity. The third lesson is the most profound. Being right too early is indistinguishable from being wrong. Mathematical truth is not enough. Truth requires time to become evident. This is the curse of the lucid dissenter in certain systems. Michael Burry's story is not about money. It is about the relationship between mathematical reality and collective belief, about what happens when those two diverge dramatically, about the specific psychological cost of being correct against universal opposition. This is the story of the man who saw the greatest financial crisis in history mathematically. He was right, the world was wrong, and the world has continued to resist learning from his correctness. Because in the end, when collective certainty is more comfortable than mathematical truth, the dissenters who see clearly are condemned to watch the consequences arrive exactly as they predicted. If you choose to witness their stories, subscribe to Rise and Ruin. Next, we follow another empire from glory to dust.